Welcome to Iron Financial. This is the only place on the street where we help you forge a stronger portfolio by cutting right through the market weakness. Today, we are putting Rezolve AI, ticker RZLV, directly under the microscope. And folks, this is a company with a story that's, well, almost too good to be true. On one side, you've got this explosive AI-fueled growth narrative. On the other, a stock price that has been beaten, battered, and basically left for dead. So the question we're hammering out today is a simple one. Is Rezolve AI building a skyscraper, a true titan of industry, or is the foundation completely rotten? Let's dive in. Okay, so let's start with the blueprint. And this one comes from the architect himself, CEO Daniel Wagner. Now, you gotta pay attention to the language here. This is not a timid statement. He's not saying we hope to be a player or we're working towards it. He's saying we are the engine. That's positioning the company not as some future hopeful, but as the essential infrastructure, the actual load-bearing beams of the next generation of commerce. This is the entire bull case in a nutshell, a claim of total market dominance. It's bold, it's incredibly confident, and now we need to see if the numbers have the steel to actually back it up. And here it is, the first piece of heavy metal. $232 million in annual recurring revenue. Now, for anyone who's new to software as a service investing, you need to understand this isn't a one-time sale, this isn't some flash in the pan. ARR is the absolute lifeblood of a company like this. It's the contracted, predictable cash flow that you can literally build a fortress on. So when a company exits the year with a run rate this high, it sends a powerful signal. It says their product isn't just some novelty, it's becoming deeply embedded in their customers' day-to-day operations. This is the number the bulls are going to point to over and over again as the solid steel frame of their entire argument. But look, past performance is one thing. Future guidance is a whole other beast. And they are not just sitting back and admiring that $232 million. No, they are telling the market, loud and clear, to get ready for $360 million in actual revenue for 2026. Let's be really clear about this. That is not a run rate. That's top-line, GAAP-reported revenue. This guidance is a massive statement of intent. They're basically telling investors, hey, that engine we talked about, it's just getting warmed up. The real acceleration is about to kick in. This is the hook that gets everyone's attention, a huge existing revenue base, combined with an even more massive projection for growth. So here's how we're going to inspect this whole structure today. First up, I am going to lay out the full bull case, what we're calling the AI hockey stick. Then, our resident market skeptic is going to come in and start looking for the cracks in the foundation. After that, we'll analyze the price of growth, because, let's be honest, nothing this big gets built for free. We'll check my blueprints against Wall Street's view, and finally, we will deliver the final verdict. All right, let's get to work. All right, let's get into it. Let's start building the bull case. And for a minute, I want you to completely forget about the stock price. Just put it out of your mind and focus purely on the operational metrics. What we're talking about here is the construction of a revenue skyscraper. And frankly, the speed at which it's going vertical is just staggering. The argument here is that the market is stuck looking at the ground floor, at the dirt and the mess, while this company is already up there building the penthouse suite. This table right here lays out the story in cold, hard numbers. I want you to focus on the insane contrast between the first half of 2025 and the second half. They started the year with a respectable 6.3 million. Okay, not bad. But the second half? 40.5 million. That is a 543% explosion in just 6 months. This is exactly what a hockey stick inflection point looks like on a spreadsheet. And just look at that last number for good measure. Nearly $20 million in revenue in the month of December alone. All the acquisitions, the integrations, the big enterprise deployments, it's like they all started firing at once. When you see a growth curve bend this sharply, this fast, it means the business has hit escape velocity. The skyscraper isn't just a plan on a napkin anymore, it is going vertical, and it's going vertical fast. And I want to be clear, this isn't just some case of a single lucky quarter. This timeline here shows a consistent, repeated pattern of setting really ambitious goals and then just smashing right through them. They started the year targeting $100 million in ARR, a big goal. By the middle of the year, they felt confident enough to raise that to $150. By December, they were reporting an exit rate of $209 million. And the final audited number? $232 million. This is absolutely crucial. It shows you have a management team that isn't just out there painting a rosy picture. They are consistently out executing their own already aggressive forecasts. For the bulls, this is hard evidence of a powerful underlying momentum that the stock market is just completely ignoring. Now, if those revenue numbers are the steel frame of the skyscraper, then this client list right here is the bedrock foundation it's built on. I mean, look at these names. We are not talking about small-time players or some buzzy tech startups. We are talking about global titans. Gucci, Adidas, Target, Standard Chartered. These companies do not adopt new technology lightly. Believe me, their procurement and due diligence processes are absolutely brutal. So the fact that Rezolve is already embedded with brands of this caliber, that provides immense validation. And it's not just the clients. Look at the partners. Microsoft and Google. You do not land these kinds of strategic partnerships unless your technology is enterprise-grade, secure, and massively scalable. This isn't hype. This is a roster of blue-chip proof points. Hold on, Analyst. You're painting a beautiful picture here, I'll give you that. A revenue skyscraper with a foundation made of solid gold. It sounds amazing, it's very compelling, but my job here is to represent the regular investor on the street, the person looking at their screen. And my brokerage account isn't showing a skyscraper, it's showing a pothole. So you have to answer the crucial question. If everything is this fantastic, if the revenue is exploding and you've got Gucci on board, then why is the stock chart a total and complete disaster? The market has delivered its verdict, and believe me, it is telling a very, very different story. Okay, let's just look at the cold, hard reality for the shareholder, shall we? The 52-week high for this stock was over $8 a share. The low is down near $1. And where is it trading now? $2.39. It is barely off the mat. So forget the press releases for a second. The market, which is supposed to be this all-knowing, forward-looking machine, has looked at this supposed skyscraper you're talking about, and it has valued it like a condemned building. My job now is to figure out why. What does the market see that the bulls are missing? It's time to put on the hard hat and go looking for cracks. So now we officially begin the bear case. And we're not going to be looking at the flashy press releases or the feel-good CEO quotes. No, we're going into the deep, dark, and, let's be honest, often boring world of SEC filings. We're talking the Form 424B5 prospectus, the 6Ks. This is where the real story is told, hidden in the footnotes. This is the official inspection report, and I promise you, there are some things in here that should make any investor, bull or bear, take a long pause. Let's start with this whole concept of profitability. The company made a really big deal about achieving positive adjusted EBITDA in December. And that sounds great, right? Profit. Who doesn't love profit? But the question you have to ask is, what is adjusted EBITDA? Well, let me tell you, it's a metric they basically invented. It's profit, but only after you ignore a whole bunch of very real, very tangible costs. Just look at this list. This comes from their own filings. They exclude the cost of paying their employees with stock. They exclude the massive costs of buying other companies. They even exclude the legal fees from their SPAC deal. It's like saying you're a profitable homeowner, but you're just not going to count your mortgage payment, your insurance, or your property taxes. It's a financial sleight of hand, and its main purpose is to mask the true cash burn of the business. And this right here, this is the first major structural crack you're going to find. This is from their own balance sheet, filed directly with the SEC. As of the middle of 2025, the total shareholders' equity was negative $14 million. Let me be very, very clear about what this actually means. On an accounting basis, it means the company's liabilities, what it owed, were greater than its assets, what it owned. So if they sold everything they had to pay off everything they owed, the shareholders would be left with less than zero. Now, sure, the pro forma numbers after their fundraising look better, but this historical deficit is a massive red flag. It tells you about the underlying health and the prior cash burn of the core business before all that new money came pouring in. And that brings us to the next critical question. This explosive growth, this revenue skyscraper, it has to be paid for, right? Nothing grows 543% in 6 months without an immense amount of fuel. So where did that fuel come from? Who is really footing the bill for this massive construction project? Well, the answer, unfortunately, is the shareholders. This number is just stunning, and it comes directly from their own prospectus for a recent stock offering. They sold new shares to investors for $4 apiece. But here's the kicker. The filing explicitly states that right after the deal closed, the net tangible book value per share would only be about 69 cents. So think about that. For every $4 a new investor put in, $3.31 of it, poof, vanished instantly into thin air. It went to pay for the higher book value of existing shares. This, my friends, is called dilution, and it is the silent killer of shareholder returns. The company is funding its growth by printing more and more shares and massively diluting anyone who buys in. Your slice of the pie is getting smaller and smaller every single time they go out to raise money. And it's not just the dilution, folks. Look at the other side of the ledger. This is the pro forma debt after they made their big acquisitions. We're talking about almost $170 million in interest-bearing debt. And I want you to look closer at that top line. Over $119 million of that is short-term, which means it's due soon. Debt is like a wrecking ball hanging right next to your skyscraper. As long as growth is explosive and everything is going perfectly, yeah, you can manage the payments. But if that growth stalls for even a quarter or two, if the economy turns south, that debt becomes a massive threat. It has to be paid no matter what the revenue looks like. This is a huge amount of financial risk that is bolted right onto the frame of this company. Okay, Skeptic, you've done your inspection and you've definitely found some cracks. I will grant you that. The dilution is heavy and that debt load is substantial. No doubt about it. But here's the thing. Every skyscraper under construction looks messy. It's got scaffolding everywhere and carries a lot of debt. You're focused on the scaffolding and the dirt on the ground. Wall Street analysts, they're keen to look at the finished blueprint. They've read the exact same filings you have, and they see a masterpiece in the making. Let's see how the professional money is viewing this story. The key thing to see here is the professional consensus. Look, it's not just one or two rogue bulls pumping this thing up. Out of 7 analysts covering the stock, 6 of them have a buy rating on it. Only 1 has a sell. This is not a fluke. These are serious firms. We're talking Cantor Fitzgerald, H.C. Wainwright, Alliance Global Partners. They have entire teams of people whose only job is to dig through these exact same filings, and they are overwhelmingly coming to a bullish conclusion. They believe the growth story massively outweighs the risks you've outlined. They are betting on the skyscraper, not the scaffolding. And this number right here puts that whole disconnect into sharp focus. The average price target from these 6 bullish analysts is $11 a share. Now remember, the stock is currently trading around $2.39. That implies a potential upside of over 350%. What Wall Street is saying here is that not only is the market wrong about this stock, it is spectacularly wrong. They are telling their institutional clients that this isn't just an opportunity, it's a potential multi-bagger if the company simply executes on its plan. That is a very powerful counter-narrative to your inspection report. And I'll counter your analyst consensus with something a little more concrete. Those $11 price targets, they look beautiful on paper, but are they actually grounded in reality? Let's look at the company's actual track record of hitting their quarterly forecasts. You know, the smaller steps on the way to building that skyscraper. In Q2 2025, they missed revenue forecast by over 27%. In their December 2nd report, they missed on revenue again. And look at the earnings per share. They were forecast to lose 2 cents a share, but they actually lost 4. They missed by 100%. So while your Wall Street analysts are pointing up to the sky with their $11 targets, the company's recent history shows a clear pattern of tripping over its own feet on a quarterly basis. It raises a very serious question. Why should we trust these massive future projections when the near-term execution has been so shaky? All right, let's bring it all together. We've seen my bull case, a revenue skyscraper being built at lightning speed. And we've heard the skeptic's bear case, a foundation with some very real cracks, funded by a mountain of debt and dilution. Now it's time to take these two conflicting viewpoints and forge them into a single informed decision. So here's the core conflict, laid out side by side. The bulls can point to that explosive 543% second-half growth and that incredible $232 million ARR. They can show you the A-list client roster with names like Gucci and Target, and they'll point to that massive $360 million guidance for 2026. This is the story of a category-defining company hitting its stride. But the bears can counter every single one of those points. They'll point right back at the heavy shareholder dilution, the $169 million in debt, the historical negative shareholder equity, and the completely disconnected stock price that just screams risk. This is the story of a high-risk, cash-burning operation that could collapse if that growth slows down for even a moment. Ultimately, an investment in Rezolve AI is not a simple bet on some stable, blue-chip company. Let's be clear about that. It is a high-stakes wager on a construction project. The bull case promises a titan of industry, a skyscraper that's going to dominate the entire skyline of AI-powered commerce. And if they're right, the potential reward is absolutely immense. However, the bear case shows that the foundation is leveraged with debt, and the construction itself is being paid for by constantly diluting the owners. The risks here are just as immense as the potential reward. This is a classic battle between an incredible, almost unbelievable growth story and some very, very troubling financial realities. So we end right where we began with that central question. Is this the ground floor of the next great AI titan? Is this your chance to get in before Wall Street fully catches on and the stock finally re-rates to those $11 price targets?
Or are the cracks in the foundation, the debt, the dilution, are they fatal flaws that will ultimately cause this entire ambitious structure to collapse under its own weight? We've laid out all the evidence, from both the blueprints and the inspection report. The final verdict, as always, is yours to forge.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.